What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, I want to share 5 what I believe are really, really important, crucial questions that you should ask your agent before you pull the trigger on an indexed universal life insurance policy. So as you probably know by now, based on, I've done tons of videos about IUL. I am not a fan of IUL whatsoever. I think it's a fundamentally flawed and risky product. I think it's a useless product, as well as the first question I'm going to give you will demonstrate and prove. But it's not even really the IUL itself, though, that I have the biggest issue with. It's how it's just so misrepresented. And like the information around it is just incredibly misleading. Like a lot of times all we hear about are the amazing benefits that we're going to get from these policies, and the risks are never disclosed. All the things that can change, all the things that can go wrong are rarely disclosed. And if they are, they're like downplayed significantly. Oh, it's not a big deal. You know, we have XYZ rider for this, and we can do that, blah, blah, like all these different fixes, right? For the numerous things that can go wrong with these policies. And it's just like, is this something that we really want to bet our financial future on? For me, the answer was absolutely not. Like when I started asking these questions that I'm going to share with you, and I started doing my research, I started to understand how these products actually work and what the risks are. It was not in my risk profile whatsoever. I wanted nothing to do with it. And I was pretty close to pulling the trigger on an IUL. And fortunately, I started asking these questions. I heard the other side of the story, and I was able to make an informed decision. So here's the thing: like if you understand like the answers to these questions, if you're satisfied with them and you still want to pull the trigger on an IUL and you actually understand how it works, you know it's going to have to be actively managed, you know how it needs to be funded and all that stuff, go for it. You're an adult, you can do whatever you want. But my problem is that I don't think people know what they're actually putting their money into with an IUL. It's all this pie in the sky fantasy land crap, with these, on these illustrations that show the market going up, the cash value growing every single year, as if we're in some type of eternal bull market. That's absolutely ridiculous. And then these proprietary indexes too. I just did a whole video on that. Like what a scam that is. Okay, maybe scam is a harsh word, but it's so misleading. And like this wildly unrealistic amount of tax-free retirement income that we're going to get. It's just like, we've got to be really careful here, guys. And you just have to make sure you understand what you're putting your money into. All right, guys, let's get started with question number 1. Why would I buy an IUL for upside potential, downside protection in the market if I can get the same thing in a whole life product? Did you guys know you could do that? Well, you absolutely can. There's 2 companies that I'm aware of right now that have these riders that allow you to implement an indexing option strategy using the dividend that you would receive, right? The benefit of this is that we don't have to worry about all the problems, all the things that can go wrong with IUL. The fact that it's built on annual renewable term, your cost of insurance is going to go up every single year. You have to manage your net amount at risk. And now you've got these stupid proprietary indexes that, this IUL agent's trying to sell you. It's like absolutely ridiculous, right? We don't have to worry about any of that. So the way that it works with a whole life policy is you can use this rider, you cannot use this rider. Personally, I'm not a fan of involving the stock market with my whole life policies, but let's say we get a correction in the market and I'm anticipating the market to go up over the next few years and I finally recover or whatever. I can turn this rider on if I want. And what's going to happen is the life insurance company, let's say I was going to get a $5,000 dividend this year, okay? And I wanted to get this upside potential, downside protection in the market. Okay, well, the life insurance company would basically take my $5,000 dividend, or maybe half of it. I could allocate half of it if I want, maybe $2,500. So $2,500 of that dividend would go directly to credit my cash value. The other $2,500 would be used to buy call options on the S&P 500. It's very similar to what IULs do when they buy call options, not with dividends, but just buying the call options on these indexes, right? Okay, so they would buy those call options, and if the market goes up, I think right now the multiplier is, or the maximizer is 12%. So if the S&P 500 goes up 12%, at least 12%, then I doubled my dividend. So if I put my entire dividend of $5,000 in this call option strategy, and the market at 12%, I would receive a $10,000 dividend credit to my cash value. Worst case scenario, if the market goes down, then I would just lose my dividend. But my policy would still grow by the guaranteed rate, which currently for this company, it's 3.25%. I think that's pretty sweet. And so but again, I don't have to worry about all the things that go wrong with an IUL. And also, let's say the market went up 10% or 8%. I might get like a 1.5 or 1.7 times my dividend. So it would still be more than my original dividend. But that's what it would have to hit, the 12% in order to double the dividend. That's pretty sweet. So turning a $5,000 dividend into a $10,000 dividend without having to worry about all the things that go wrong with an IUL. That's why I think IUL is just completely useless. Because one of the big selling points of IUL is this upside potential, downside protection in the market. Sounds really good, right? And it is. That's a cool strategy. But why inject all the risk in your finances with an IUL to get that when you could get that upside potential, downside protection in a whole life policy? So that's why I think IUL is pretty useless. Question number 2, it's actually a 2-part question. Can I lose money in my IUL, and how? How do I lose money? How can I lose money in my IUL? Guys, I can't tell you how many agents I have seen, like on public forums, on social media platforms, comment sections saying, like even in their videos, you can never lose money in an IUL. I hear them say that over and over and over again. It's free from, it won't have any losses or anything like that. It is so misleading. It's a half truth, because it is true that with an IUL, you can't lose money in the market because you're not directly invested in the market. It's a call option strategy. Okay. That part is true, but that doesn't mean you can't lose money in an IUL, right? There's a very big difference between saying you can't lose money in the market versus you can't lose money. Very, very big difference between those two statements. And there's only a couple of words that are different there, right? And that are missing. Okay. But they need to be said, because you can absolutely and will lose money in an IUL when you have a 0 year. Here's why: because there's still costs and fees associated with the policy. And as you get older, because it's built on annual renewable term, that cost of insurance is going to go up every single year. You have to manage net amount at risk. We're going to talk. That actually brings me to the next question here in a second, but let me finish up with losing money in an IUL. The biggest problem with IUL is not really, or like the problems don't really start to show up during the growth and accumulation phase of an IUL. Okay. It's in the distribution phase when you start taking income from it, when you start racking up this really large policy loan to get this tax-free retirement income, which, look, with life insurance policies, can they create supplemental retirement income? Sure. But you've got to be really, really careful with something like an IUL. You do have to manage it in a whole life policy too, but there's not anywhere near as many problems. All right. That's a different video. But my point is, you can absolutely lose money in an IUL. So let's say you're 65, let's say you're 70 years old. You've been taking income for 5 years now. Let's say you've racked up a loan balance of $200,000, $250,000, which that's not hard to do with how much income they typically show you taking in these policies. I've seen upwards of 12% distributions in these policies, like insane numbers. So let's say you rack up that loan balance and you have this 0 year. Okay, well, you didn't lose money in the market, but where does your cost of insurance come from? Where do all the other any other fees come from? Where does the interest on that loan balance, which hovers around 5%, where does that come from? That comes from the cash value, which means you are losing a pretty good amount of money in your IUL on a 0 year. The market doesn't even have to go down. If it just did 0 and you did not get the credit that your illustration showed you getting every single year, which we're going to talk about that too, like where does all that stuff come from? So you can absolutely lose money in an IUL, guys, and you need to be aware of that. And if you're okay with that, fine. But so many people, I don't think a lot of people are aware that they can lose money in an IUL and how. And you have to understand that so you can plan for it, guys. It's just ridiculous. All right, that kind of brings me to question number 3. What is the difference between cost of insurance and net amount at risk? As a consumer, you should absolutely be able to explain this. And if you can't, you are not ready to buy an IUL, because this is so important, guys. And it's another very misleading part of the marketing around IUL that I see that just makes my skin crawl when I hear it. When I hear agents say, oh, your cost of insurance actually gets cheaper. It goes down when you get older. What are you talking about? That is such a lie, at best a misleading half truth. And here's why. So IUL is built on annual renewable term. Okay. What happens with term insurance every single year that you get older and you still own it? It gets more expensive. It just makes sense. Not a bad thing. It just is what it is. It's like, for example, if you were to buy a 10-year, let's say a 30-year term policy, 10-year term policy, it doesn't matter. You let it expire, but let's say you want to renew it. you're going to notice that it is a lot more expensive, that the cost for it has gone up pretty significantly since you're now 10 years older. That's how term works, right? So with annual renewable term, your cost of insurance is getting more expensive every single year, exponentially more expensive when you are older. What these agents are typically talking about when they're saying your cost of insurance is cheaper is they're talking about your net amount at risk. Okay, so here's what net amount at risk is. This is how you determine it. If you just take your death benefit minus your cash value, you get the net amount at risk to the life insurance company. That is what your cost of insurance is applied to. Okay, so for example, if I have $1 million death benefit and I have $900,000 in cash value, what's the net amount at risk to the insurance company? It's $100,000. Okay, that's what I would be paying, the amount of insurance I would be paying for that particular year, however old I am. But again, the actual cost of insurance is going up every single year, but you can manage, if you manage the net amount at risk, you can keep the actual, what would you call it? The actual cost itself coming from the policy, the premium that's due on the policy, you can keep that low if you manage the net amount at risk. But again, this also brings up a lot of issues because one, you have to, you better hope that your policy performs close to what was illustrated, because if not, you're going to start running into problems with net amount at risk. And a lot of times to manage net amount at risk, you have to lower the death benefit. It's one of the, what do they call it? The flexibility benefits of this universal life chassis, that you can adjust the death benefit. Okay, well, you better be careful how much you lower that death benefit because you could end up mecking the policy. Not to mention that's going to impact the continued performance of the policy. It's going to impact how much income you're able to take. Like, it just creates all these other problems. So look, if you're okay with stuff like that, fine, but you have to be aware of this stuff. And like, your head might be spinning a little bit. Mine is a little bit explaining this stuff, right? And it's like, do we really want to roll the dice with our financial future on this kind of stuff just for an extra couple of potential percentage points of growth than what we would get in a whole life policy? Like, it's just ridiculous. So yeah, have fun with that stuff. All right, question number 4. If the market doesn't go up every single year, why does the illustration show my policy growing every single year? As if we're in some kind of eternal bull market. This was like a huge red flag for me when it came to IUL, especially the illustrations, because the market doesn't go up every single year. And guys, it's not an average that's being used either. And if they're claiming that it is, again, it's very, very misleading. There's a number of different reasons that doesn't work. Because one, you're with an index, with an IUL, when you make your premium payments, not all of that money is being invested into the indexing strategy. All right. Obviously, there's cost of insurance fees, et cetera. So the money you're putting in can't be compared to the same amount of dollars being put in directly into the market, because not all those dollars are being actually invested in the market or the indexing strategy. Right. So that's number one. Number two, this is a call option strategy, which means there is a cost to those call options, and they fluctuate literally every single day based on volatility. So what happens if the cost of those options skyrockets? How is that going to impact the performance of the policy? Well, you have to take that into consideration. So again, that's very different than being invested directly in the market. Not to mention too, IULs don't get dividends from the stock market, because again, you're not invested directly in the market, so you're not going to receive those dividends, which I think equates to like a 1.5 or 2% of the overall returns of the S&P 500. So again, just using an average of something like the S&P 500 to create this illustration is very, very misleading, because it's a completely different investment. It's a completely different type of product, I should say. Very different exposure, different costs and fees associated with it, right? And so here's the other thing though, okay? This is the biggest issue for me, is that even if they were using like an actual average rate of return, okay, average rate of return is in and of itself very, very misleading as well. I've done videos on this, guys. I've run the numbers using these average rates of return, okay, where basically what I did was I did a hypothetical example of I took $100,000, invested it directly into the S&P 500 in a specific year. I think it was 1988, went all the way to 2024. It was a 35-year time frame. And I calculated all the ups and downs, all the gains, all the losses, percentage-wise, came out to a very specific number. And it was fine. Like, I'm not saying there's anything wrong with investing in the market, okay? But I came out to a very specific number. What I did was I divided it by the number of years. I got the actual average rate of return for that time frame. Okay. I then went to a compound interest calculator. I plugged those numbers in, same dollar amount I started with, same time frame, put in that average rate of return. It was $1.1 million more than what I actually ended up with if I was directly as I was invested in the market, had I been. Okay. It's a huge difference. The problem with average rate of return is it shows the account growing by the same amount every single year. It overstates gains, understates losses, not to mention fees, taxes, all that good stuff as well. But average rate of return in and of itself is extremely misleading. So when I see an IUL illustration showing 6.97% every single year, illustrating like a CD product, like it's going to grow every single year, that is not going to happen, guys. And it gets even worse later on, like when you're supposed to get $100,000 credit or $200,000 credit, $50,000 credit, I don't care. When the numbers start getting bigger and you don't have that, you're losing money in the IUL, because when you have that 0 year, you have costs, fees, interest on your loan balance when you start taking income. Okay, so you're going to go backwards because of that. And you did not get the $50,000 credit you were supposed to get that year. So then even next year, if it comes back, you're still way behind because you're not getting credit on the additional $50,000 you should have had last year. See what I mean? So showing it growing every single year on a product that's based on the stock market, give me a break, guys. It's very, very, very misleading. All right. Final question, number 5. I've kind of alluded to this already, but I think it's really, really important. I want to make sure I hammer this point home. When I start taking income and eventually have a loan balance of, let's say, $200,000 at a 5% interest rate, all right, and then I have a 0 year because the market went down, how does the interest on the loan get paid? Okay, I already mentioned that a little bit, but let's dive into it a little bit more in a little more detail here, because this is so important, guys, because these things are sold based on upside potential, downside protection in the market. You can avoid all these losses, right? And you're going to get all this amazing tax-free retirement income because of these policy loans. And it shows the policy growing every single year. Except when you have that loan balance of $200,000 at 5%, what is that? Is that 10%? Yeah, so $10,000. Okay, where's that $10,000 come from? I thought you couldn't lose money in these things, right? How does that impact the future performance of the policy? How does that impact the amount of income you're now able to continue to take without potentially lapsing the policy or running out, like just running the policy into the ground, having to turn on that overloan protection rider that's supposed to be this, your saving grace, whatever, right? So it's something to be aware of. And now here's the thing: the pushback that or the rebuttal I'll get from IUL agents on this is that we can do a wash loan. Don't let them fool you with a wash loan. And if they are going to tell you to use a wash loan, make sure they illustrate it, because 99 times out of 100, what they're illustrating is what's called a participating or indexing loan. Meaning when you take policy loans, all of your cash value is still getting any interest credit when the market does go up. Okay. But there's an interest cost to that. It's hovering around 5%, give or take. Okay. That's what they show on the illustration, because also it shows 50 basis points of positive arbitrage every single year. It helps to disguise the cost of the interest cost and really all the other costs involved with the policy. It's just absolutely insane. But whatever, I digress. What they'll say though is, you could just do a wash loan instead. But what that means is if you do a wash loan, the money you take out, let's say you take out $50,000, that $50,000 is no longer available in the cash value to earn interest. Okay, so now that's going to have a massive impact on the long-term growth of the policy. Again, if you're okay with it when you see it, fine. But don't let them just say, you could just do a wash loan without showing you the impact that that's going to have on the growth of the policy. Because I'm not going to say I'm going to guarantee it, because everybody's risk profile is a little bit different. But if you saw an illustration with a wash loan on it instead, you probably wouldn't buy it. A little bit more, very likely you wouldn't buy it. So that's why a lot of times they don't illustrate showing wash loans, right? But the reason they'll say you can do a wash loan is that you don't have to worry about the interest compounding against you, which is true. But it still doesn't solve the problem of how it impacts the long-term performance of the policy now as well. Like, Is it worth it at that point? I don't know. You'd have to make that decision. But don't let them say, oh, you do a wash loan without showing you on the actual illustration, because they always illustrate showing that participating indexing loan. And that's what has the interest credits. The interest cost to the policy at that point, on the policy loan balance. You have to be aware of this stuff, guys. These are all the things that you need to be aware of. You need to manage with these policies. Otherwise, you can run into a lot of trouble with these things. There's just so many things that be changed. We didn't even talk about cap rates being changed, participation rates. Like, you could ask them that as well. Like, how many times on this product that you're showing me have the cap rates been adjusted over the last couple of years for previous policyholders, and see what they say. So anyways, I hope that was helpful, guys. I just think that these types of questions are really important to ask when we're talking about major financial decisions here. Okay, we want to ask as many questions as we possibly can so that we are making the most informed decision possible. Okay. All right. That's all I got. Hope this was helpful. I would love to hear your questions, feedback, comments, all that stuff down below. Make sure you check out all the links in the description. I'll have additional training for you guys in there. And I will talk to you in the next one. Cheers, success. Matty Ice is out.